Good morning. Welcome to the Gabelli Financial Services Opportunity Fund webinar. My name is Michael Cronan. I'm president of ETF Insight, an educational-focused ETF content company. And with me today, I'm joined by Max Sykes, the portfolio manager for GABF, the Gabelli Financial Services Opportunity ETF. Welcome.
Thank you, Michael. It's a pleasure to be here.
Yeah. So, today we're going to really dive into a bit of the weeds on the GABF, and it's an opportunities fund. So, we're gonna dive into what the opportunities are. So, why don't you just give us an overview of the fund itself, and then get into the objectives, for the ETF and how it's doing, and we'll kind of dive into what your thoughts are around the space and how you see it evolving.
Great. Well, maybe just start with a little brief overview. So again, my name is Michael Sykes, portfolio manager at Gabelli Funds. Our firm was founded in the 70s, and we have about 30 billion under management today. It was obviously founded by Mario Gabelli, and we follow a private market value with the Catalyst research methodology. So it's a value approach where we look for companies that are trading at a discount to what we believe is their intrinsic value, and then we marry that with a catalyst to narrow that discount. For me, it's not necessarily also about finding cheap companies, but also companies with compatible, sustainable business models and positive outlooks as well as entrepreneurial mindsets.
Right. So you're looking at management team, different areas of the business, really digging into, what's driving the business, what's driving growth, and what's evolving, correct?
Correct.
Right. And do you also kind of take into account how well they're integrating technologies and those types of issues as well?
Right. So we started this fund in May of 2022, and we launched it on the floor of the New York Stock Exchange, which was pretty exciting. And the general theme is taken from what Warren Buffett calls as the American tailwind of prosperity. And when we measure this by U.S. household wealth, so if you go back to 1971, there was about 5 trillion of total. Today, it's over 155 trillion. So you can see the compounding that's occurred over that time frame, and we expect that to continue, just given the outlook for America, our current state of law, and growth, and what we do here. And so that is an undeniable trend in our opinion, and financial services are a great place to play that. And so there's several themes from that, whether it's wealth, payments, demand for asset management, or other financial services companies. So we believe that this will be a nice tailwind for a lot of these sectors, and that there are companies that are really well positioned to benefit from that.
Right. And so, just from a fund overview perspective, this is an actively managed fund. What's the turnover like? I'm assuming it's not a heavy amount of turnover, but there is, your active catalyst program where you're constantly reevaluating companies. So talk to us about that process.
So that's a great question. A couple of points. I think traditionally as a firm, we have generally low turnover. We're looking for really durable compounding businesses. So it's really reflective of finding those and buying and holding them. And obviously there's a tax efficiency to that. Secondarily, just having the ETF structure that we have also provides benefits to tax efficiency through the create redeem process, as we all know. But I would just say we've had a brief history. There was some elevated turnover because of some of the financial services events last spring. But for the most part, it is settled into kind of our norm here at the firm and mirrors that. And I think that reflects our confidence in the businesses we've selected, with the idea that we're going to own them from 3, 5, 10 years from now. And so every selection that we do make, we are thinking about the sustainability of those earnings outlook, competitive dynamics, et cetera. So we want to own these businesses for a long time. And I think that you'll see a lower turnover, and that will come out and we have not paid out a capital gain distribution.
Okay, right. Well, the ETF wrapper really helps that as well, right? The way you can manage the portfolio to manage so the capital gains hit, if you will. But I think it plays into who you are as a long-term value manager, right? That's just the way you've kind of grown up, right?
For sure.
So, as you start to think about, financial services overall, I'm, assuming you have sort of a worldview, but, local holdings. Is that correct?
Right. So we're security selection is bottoms up.
Hmm.
But we obviously pay attention to some of the macro drivers, including rates, outlook for credit, GDP growth, consumers, et cetera. There's a lot of factors that go in that drive the earnings power of a lot of these companies that we look at. So again, though, we look at it a bottoms up opportunity, the discount to intrinsic value, and then the executing management teams that are powering those companies.
Right. So rates. We want to just talk a little about rates for a minute.
Oh
It's
boy. Okay.
we've had 1% rates for like 10 years, and then now we went up to 5%. We're back in the fours now. How are these large financial services? How do they think about rates?
Right. So obviously you can't have a strategy like this without, constantly paying attention.
Yeah.
I will say one of the great things about having the ETF at Gabelli within our bigger branch here is that, we have a great money market team. And they give you constant updates on, the dynamics that are going on. And so there's a lot of people here that we can lean on to understand the landscape a little bit better. I think from our perspective, it's our view that it's just very, very difficult to predict rates. I think we've seen the Fed. I mean, they're the smartest with the most accurate data, and yet it's been a challenge for them, obviously. And we don't try to select businesses figuring out where the 10-year is going to be in 6 months. I think we look at businesses like JP Morgan, for instance, has been operating for over 100 years, through high rate cycles, low rate cycles. And we look for, those companies and, that can adjust to that. And obviously profitability, the yield curve dynamics will change in the interim. But over time, I think these businesses like JP Morgan and so on that we've put in the portfolio will react and benefit. And as you say, we went through an ultra low period of rates, and that caused some disruption, and now we're kind of normalizing, and that's more of our view than kind of an out of control rate environment. Although we have to be careful of the deficits and so on.
Right.
But in a normalized rate environment, I think is a pretty good environment for our strategy and the companies that executed that.
Yeah, I mean, also if you think about timing, you've really timed this right. I mean, you're launching last year in May. 2023 is now being known as the year for the active ETFs. So it's really, there's more active ETFs launching this year than passive ETFs. So it's really, it's great timing. The other thing that I've found is that, I grew up with, the mutual fund industry, and, you get used to hearing about the calls with the companies and having that sort of direct dialogue with either the financial team or the senior management team. Now you still do that, right? With a lot of your holdings, or you're listening to earnings and you're really paying attention, right? Is that correct?
Yeah, well, a couple of things on that front. We work very hard here. We have a very intense approach to research, and that that includes communication with management. And we're very lucky that we've built a good brand with Mario and his huge history of investing in the business. And so we're able to get access to some great management teams. We visit all the companies that are in our portfolio. We're active dialogues with the management teams. Obviously, with some companies, Berkshire Hathaway, for once, it's a little bit different in terms of the investor access. But we go out to Omaha each year in May, so we cover that. But yes, this is very active dialogue. It's a very big part of our process, and communicating with these different companies, whether we own them or not, is a great way to create a mosaic for investing in general, and that can inform you on a daily basis.
So you mentioned Berkshire. There was a significant event yesterday. What do you think of the passing of Charlie Munger, and do you think it'll have any impact at all on the company?
Right. So Berkshire is one of our largest holdings, and we followed it for years. And as we said, we go out there every May for the annual meeting, and it's a big part of our culture here in terms of understanding and drawing from that intellectual capacity. I think at age 99, it was not unpredictable that there would be a passing at some point, but it was a surprise to get the news yesterday. And obviously, you know, being a legend in the business, it's a sad passing.
Right.
I think for Berkshire, having somebody like Munger there, you know, and then building up a team around him. I mean, there's a
Right.
very competent, very in-depth management team with clear succession plans in place. And so you have to feel good that the culture will retain and that the execution will be there. And so I think, you know, the stock price, I don't think it changed much today. And
Right.
we knew that he was a little bit older. So I think they'll do just fine. And for the next
Right.
100 years, I think shareholders will make a lot more money as well.
Yeah, no, it's you know, as you said, it's a sad passing, but you know, it such a well-run company. You wouldn't expect something. You know, they have succession planning at their core, so I'm sure this will just be a blip, but it's you know, it's still you know, you never want to, you know, kind of live through those types of passings. So
And Mike, I would remind our viewers that you know that are enthralled with the Magnificent Seven and the cash generative
right.
component. You know, Berkshire Hathaway has 152 billion of short-term equivalent cash on its balance sheet, so
Right.
that can be invested. It's obviously earning high rates today, where rates
Yeah.
are. And last quarter, in the third quarter, they generated $800 million per week of operating earnings.
Wow.
And so that needs to be invested in, and they have a lot of great business to do. And their insurance business is just performing at a very high level today because of the inflationary environment and because of the investment opportunity that they have.
Right. Yeah. No, it's a very well-run company, and I think that you know, there's a real reason why you have it as your number one holding. So so let's kind of backtrack a little bit, talk a little bit about yourself, a little more detail. You know, how'd you get here? You know, what are the things about Gabelli that you like most? Just, you know, give us a little sense of a view of a person.
So I benefited definitely from a little bit of nepotism. My grandfather was a governor on the New York Stock Exchange, was in institutional business. My father was a hedge fund manager. And then myself at an early age was really interested in kind of the stock charts and tracking the different companies. And I remember when my dad would bring the paper home, I'd circle the different quotes and so on. I had no idea what I was actually looking at. But you know, you could understand what Coca-Cola was or JP Morgan.
Right.
And I just love following those numbers. And then it was quickly apparent that when I got into college that this was going to be a career that I wanted to pursue. And so I actually got my Series 7 when I was a senior in college to show the hiring firms that how eager I was to join them. So that was a little bit different for me. And then I got to go work at a great firm, DLJ, which became Credit Suisse. And then I migrated to the research side and attended Columbia Business School, where I fell in love with the Berkshire ethos and Warren Buffett, and obviously the connection with Mario and what we do at this firm, and joined in 2008 here to cover financials. So you can imagine how much I do love my job.
Yeah.
Joining it at that time. So it's been a great run, and I'm just thrilled to be here to be able to launch this product. And again, we have a very entrepreneurial approach here at the firm. I think that reflects a lot of our thinking and a lot of how we select the companies that we want to be involved with, and also my background in terms of getting to where I am today.
Right. And I know when we started, you were talking about the American tailwind. And that I think was mentioned in the, I think 2019 Berkshire letter from Warren Buffett. So you want to talk to us a little bit about the American tailwind and, you know, how we should, you know, how our viewers should think about it. You know, I know the growth of it is pretty amazing. But try to, you know, if you could give us a sense on your views there.
Right. And I think, you know, that just goes to, you know, how Warren thinks about the competitive advantage of our country and business and capitalism here. And it's reflected in just the number around U.S. household wealth. So, you know, we talked about in the 70s being 5 trillion. It's 155 trillion. Those are real numbers today. And so you've had this incredible corporate tailwind that's reflected there, and the companies have benefited. And even though we do run a thematic sector fund, I mean, these companies are really leveraged to a lot of great parts of corporate America. And so even though it's sectorized, it is very diversified in terms of some of the touch points. And, whether it's payments, and that's consumer consumption, et cetera. And, demand for asset management, demand for wealth advice, et cetera. Today, GDP was released 5.2%, and that's real GDP.
Wow.
Okay. And I think Mario reminded us in the meeting that, if you add on inflation, you're up to 9 plus of nominal. And if you think about the earnings of companies, they're measured in nominal terms. Right. And so, that's 9% growth is pretty significant.
Yeah.
And so even though we're all worried about
when was the last time we've had 9% growth?
Well, in nominal terms, I mean,
Yeah.
no, it's quite extraordinary, especially coming out of what we've just gone through. But obviously a reflection of the stimulus, both monetarily and fiscal. But the point being is that we have this incredible tailwind, standard of living, and we're all going to benefit from. And there are select companies that will do particularly well. And for our perspective, I think those are the companies that we selected. And we'll outperform and do right by investors.
And so when you think about financial services, I think you've naturally kind of drawn to this sort of generational wealth transfer that you hear in the paper all the time, right? And I've heard 20 trillion, I've heard as high as 100 trillion, right? It's like that number kind of floats around. I think 20 is probably more approachable, in the nearer term. So what's your view on that, and how it will affect the financial services companies?
Right. So these are, as you say, pretty significant numbers. And we think about the aging baby boomer population, and then the younger cohorts, the millennials, Gen Zs, et cetera. And so, if you think about the stock portfolios, those will kind of pass through. So that ownership won't really affect it. But household wealth too, whether the transfer of the house, that will go down. And over the next decade, this is the Federal Reserve numbers. They're talking about, as you mentioned, 16 trillion over the next decade. So 1.6 trillion of stimulus effect into that younger generation. And so that will create obviously more demand for wealth advice, asset gathering. So, great companies like Schwab, Interactive Brokers will benefit from that. One area of asset management that we see doing better, though, as a direct beneficiary of that, is alternatives. So if you look on the next slide, this is an area we've been particularly keen on. And so you have some great companies: Apollo, Blackstone, Blue Owl. You may not be familiar with them. They're not totally household names. But on the left, we have a chart where, you've had the sophisticated asset allocators, the endowments, et cetera, that have benefited from this kind of diversified asset allocation exposure to these firms, and the individual investor, high net worth, has been less. And so we see this major shift coming. And if you think about global invested assets being over 100 trillion, just a small shift for the individual investor will be pretty significant. And so that democratization is a big part of what we think will power some of these firms. And you think about Apollo and Blackstone in particular, they manage in total 1.6 trillion, growing very significantly in terms of new assets. And then you have specialty firms like Blue Owl, which is an incredible private credit offering, GP stakes business, and a real estate business, very innovative and growing nicely too, within kind of an overall churn in the marketplace.
Yeah, I mean, it was, as we were preparing for this, obviously I was familiar with Apollo and Blackstone, but not familiar with Blue Owl. I know they're sort of a newer, not new, but a newer company. And so, I think that, as these opportunities, evolve, you have, newer companies coming into the space that most people might not be familiar with, but are very well run, profitable companies. So what's their sort of secret sauce, if you will?
Well, I think, especially Blue Owl, you have, there are three division heads, or, kind of entrepreneurial approaches. They've built up incredible businesses. They've obviously performed very well and attracted asset flows. So I think that the history speaks for itself. and now they're pecking at this huge opportunity.
Right.
And so you have the most able, the most capable investors, and now it could just be a waterfall of investment in asset gathering opportunity.
Mhm.
And so they're extraordinarily well positioned. They have the brand and scale to execute on that. And again, these are companies that are trading at financial services multiples, but growing pretty significantly, 10%, 20% plus, with huge opportunities in terms of shifting TAM, which we all focus on. So I just
So just from an acronym standpoint, what's TAM?
that is a total addressable market.
Okay.
All right. And so if managed assets globally are 160 trillion or whatever it might be, a 1% shift in that is,
Right.
reflects multiple trillions. And you're talking about, Blue Owl and Apollo and Blackstone just being, 2 trillion of AUM.
Right.
So, they could double their businesses and still be, insignificant portion of that.
Right. So, I know there's another part of the portfolio, which is the payments, and digitizing of payments. So,
Okay.
yeah, just advance the slides, the up and down.
Here we go.
There, perfect. So can you talk us through the SME payments, digitizing opportunity here and how you think it's going to affect companies in your portfolio?
Right. I think everybody's well aware of the success of payments and innovation. We know MasterCard and Visa, and there's a number of fintech companies that are executing well. And again, we can all appreciate the fact that, when we go on our apps and so on, commerce has been much more technologically savvy, and we're all adjusting that. So as an industry, payments are growing at 8% plus. And we could talk about American Express if I jump into that. That's the next slide. As we execute our technology here, but this is a wonderful brand, an incredible company. It's been around for a long time. And when investors say, well, geez, I want to select the next hot fintech. Well, you don't need to do that.
Right.
You can get a wonderful company with a huge history of execution, an incredible management team, and a product that everybody loves.
Right.
Right. We're all familiar with the product. And here are the simple kind of fundamental drivers. As I said, the industry as a whole is about 8% growth. American Express is in the higher, faster segments of that. So it's predicted to grow at 10% plus top line. This is a major S&P company doing that. Pretty good visibility. And then when you combine their capital return, so they're buying back shares, et cetera, improving margins, you get mid-teens growth. And this is all based on a business generating 30% ROEs. We know they're a somewhat capital light business given their charge business, and 80% of that going to revenue. So unique client base, very durable. So here you're getting a company levered to the payments, sophisticated management at 14 times earnings, with a tremendous history of success, and capital allocation. So I think you don't have to think too much about this, and this will be a staple, and also an incredible juggernaut in terms of navigating the space, which we know is very competitive.
Yes, I mean, just as an American consumer, right? It's getting your first Amex card, as you're leaving college and starting out is a significant event, right? And
For sure.
having access to that. So yeah, it's definitely like Berkshire, it's sort of an American legend kind of thing. So we all know that technology has a large impact on financial services, and in client engagement. What's your, obviously things are accelerating. How fast is this going to get with AI? I mean, what's your view?
Right. So this is one of my favorite slides. I put this together a few years ago, but I think what it demonstrates in terms of the evolution of technology and client engagement is the velocity, and the opportunity, right? And so, for Facebook to gather, or Meta to gather the clients the way they did in such a rapid fashion, these businesses can really generate shareholder returns very quickly, and that's on the benefit of technology. And, for a business and sectorized fund like we have,
Mhm.
we have the benefit of having much lower multiple companies, but even though they're not pure technology, are highly levered to technology. So on the next slide, we JP Morgan, right? So
Yep.
everybody's familiar with Jamie Dimon and the brand
Yes.
itself, but they are an incredible tech star in terms of they spend $7.2 billion this year on technology, right? Cloud, client engagement, apps, whatever, risk, cyber, all this. That's double the business of, say, a cloud provider like Snowflake. And that's what they're spending. And so anecdotally, JP Morgan is a good case study for the landscape overall. So if we're looking for clients that are saying, you know what, how do we benefit from this huge uplift of productivity that's going to come? And financial services is a great place to look.
Right.
So, obviously you have large customer bases, significant data, and that's what they're going to be processing through AI, and then huge installed platforms. So the deflation that occurs through the technology costs will benefit them.
Yeah, that's a great overview for JP Morgan. I think they are such a well-run company that it's nice, it's fun to watch,
For sure.
and see how they just execute at such a high level. So I know FTA Aviation, FTAI, they're also a firm that you really like. Tell us a little bit about what you're seeing as you dive into numbers and look at them from a portfolio management perspective.
Right. So there's a couple of firms that are a little bit differentiated in our portfolio. FTAI Aviation is one of them. This is a company I've been following for a long time. Came public a couple of years ago as a former closed-end fund within the Fortress group of private equity. And it's run by a gentleman named Joe Adams, who is, essentially the leader of this alternative platform for leasing. And their bread and butter is the aerospace business, but they differentiate themselves through engine leasing.
Okay.
And so this is similar to other leasing companies, but they really differentiate a $2 billion portfolio. And when you think about what has happened coming out of the pandemic, there's been huge demand for travel and huge strain on the companies to make sure their planes are flying. And so they've delayed their timing for shop visits. And FTAI, what they do is they buy and sell engine assets and get those ready. So when planes need to be serviced, they can switch those on and they can be still in the air. And so what you've had is this incredible buildup of assets, and now it's extraordinarily well positioned because lease rates for their engines have gone up significantly. And so their ROEs that they're generating on their capital base are pretty significant. And if you look at this slide, it shows you, back in 2000, EBITDA was 300, and now they're on a run rate for over 600 as of 3Q. And the goal is to get to $1 billion in a couple of years. And so we think that's a pretty good outlook for a company. It's trading around $40 a share. We think the company could ultimately be worth 100 when they're get to $1 billion of EBITDA, decent multiple there. And so yes, it's not a payment or a custody business, but it is a unique alternative manager, and they're doing an incredible job with a great outlook, and also a 3% yield. I would note.
Wow, that's great. I mean, I know I was watching CNBC the other day, and they said that the top 7 of 10 travel days happened in 2023 as sort of overall volume. So I think we're only going to see volume grow in the number of flights, and you need engines to fly, right?
and one other competitive aspect is that they've been around the business for a long time. They really know the cycles,
right?
And to the extent that credit costs have gone up for the whole industry, it's made the assets that they may buy get cheaper,
right?
And to the extent that they've been well capitalized, it offers an even bigger opportunity for them to buy assets on the cheap and generate those leasing returns. And they've done an incredible job doing it. And again, I mean, I just think somebody like Joe Adams, entrepreneurial investor, great support, nice tailwinds.
Right. Yeah. So as we're talking about the tailwind for these financial services companies, we've also highlighted a few other segment. So you want to walk us through what we have here?
Right. I would just say that as we go through our portfolio, we're very proud of the execution and the level of management that is in place. And this slide really speaks to some of the accolades from these businesses, which we believe are world-class, reflect a lot of the governance that you would expect in really well-run companies and employee bases that appreciate management, and you get the best execution from that. And so just to call out a few of the names that are from the portfolio that we're proud of and that are aspiring on these lists.
Great. Yeah, I mean, I think that, as you look through this list in particular, these are all names that most people will recognize as well-run companies that are in the financial services. So you would expect to find these here in this fund. So let's talk about performance. That's always the thing that investors look for most, right? Is how is it performing? So, you've been out 18 months. How has the fund performed?
Well, I would just say that we focus on finding, those discounts to intrinsic value, and then seeing those narrow. And so our first and foremost focus on the research side is the business, the durable component, the returns, the outlooks, et cetera. And if we do a good job doing that, understanding the businesses, being in touch, et cetera, then I think the returns will reflect that.
Right.
We have benefited since our launch from some good returns against relative to benchmarks. I mean, obviously, it's a long game.
Yep.
But we've also had some good one-time events and some opportunities to take advantage of the marketplace, given some of the volatility. But we want to continue to work hard for shareholders and continue our process. And you outperform sometimes, and you underperform to others. But over the longer time, we think we own a collection of businesses that will do very well.
Yeah, and I think value. When value meets momentum, that's when the funds perform. And as you can see here on the chart, GABF is up 28.1% on the 1-year basis against a benchmark of the S&P Financial Index of 11.7%. So great job. And I think that as your value research will continue to play out, I expect you guys to at least outperform the financial index. But it's past performance does not indicate future growth, as the compliance team always loves to remind us. So but you should be proud of what you've been able to accomplish so far.
Thank you. And I will have the benefit of speaking to a management team a little later today. It's a firm that we've owned for a while, W.R. Berkley.
Okay.
And they're a smaller Berkshire boutique in terms of their insurance offering. And if you go to page 11 of their annual report, so the easiest way to do research is just to go to the annual report, and the really good companies list their historical performance, and W.R. Berkley is a leader. And if you just go to page 11, you'll see that their CAGR since the mid 70s or early 70s has been 27%.
Wow.
In terms of shareholder returns, compares to 12% of the S&P.
Yeah.
And as you say, that history doesn't necessarily guarantee future performance and all the disclosures. But boy, understanding that level of execution, understanding the business component should give you confidence that they can continue to execute on their historic ideals in terms of being competitive.
Right.
And so, and there's a company that trades at 12 times earnings.
Yeah.
So, and it's done, extraordinarily well. And I expect them to continue well. And it's not a high flyer, and they quietly just do a great job. And again, as we mentioned before, this environment for insurance companies is actually pretty incredible. Cat losses aside, which is a normal component, the wildfires, hurricanes, et cetera, loss ratios, that's a part of the business. But the higher inflationary environment that we're in is very helpful in terms of rewriting premium. And then the higher interest rates. So for instance, W.R. Berkley, their investment yield on 18 billion of fixed income securities was about 4.5% in 3Q. So that was their yield. They are reinvesting that at over 6%.
Wow.
So there is an opportunity to keep harvesting yield out of there and keep boosting ROEs. And so at the same time that they're growing their book.
Right.
So great cash generator, wonderful management, and just a huge history of execution.
Right. And so are they focused on just slow and steady growth? Is that how you would kind of characterize?
Well, I think the insurance business for them is been a pretty good tailwind in terms of inflation, right? And then underwriting in a responsible way. So they have a good culture for doing that. They've also added a boutique. So they added different lines, not necessarily commoditized lines, that are, very difficult to get scale and compete on. And so they've done a very thematic and thoughtful growth trajectory in terms of adding premium opportunities. But then they've also been very smart about capital allocation, and probably, you really need to get into the financials to understand the power of that. You see it in the numbers, but they were able to pull back when they needed to. And then when there are opportunities like we have, which is an extremely hard market, you got to put a lot of capital work and take advantage of it. And this is incredible opportunity today, when a lot of companies are pulling back for underwriting issues.
No, that's impressive. I also see on our top 10 holdings here, Interactive Brokers, which are, obviously, they're, I think the leading online broker. That's correct. What are your thoughts within that business? It seems to be very well run.
Oh, extraordinary. And, you have an incredible entrepreneurial alignment too on that one. Insider zone, a significant chunk of that. So not likely to do anything stupid. Or risky. And so Thomas Penderfee has built an incredible business. They have a global moat, 2.5 million users, and growing at 20% plus. And you think about the Schwabs being over 30 million accounts. So there's still significant opportunity for them. 400 billion of equity. And they've had a nice tailwind in terms of rates, because some of those deposits that they hold, they don't pay out on, so they're able to earn a nice spread on that. And today's short-term rates at 5%, it's a pretty significant carry for them. It's helped boost their margins to over 70%. So they're just a capital generating machine. They keep reinvesting in their platform. It's automated, it's unique, and so there's just a huge road ahead for this business. And then one interim catalyst is that they've adopted an institutional relationship with a international securities firm, so that they are going to adopt Interactive Brokers platform, white label the services, and use their back office. And so that will be a big step up in the next couple months in terms of their account growth and their asset levels. So I see pretty good opportunity for them. And if you just look back a couple of years, that they've done a great job. And when you have a company earning $6 a share and a couple of years earlier $1, they're doing something right.
Absolutely. That's great. So, I want to just talk a little bit about ETFs here. You want to talk a little bit about this first point here, why Gabelli, decided to offer ETFs. And, the ETF wrapper is incredibly efficient, right? It has tax efficiencies. The industry has focused on lower costs. And it's available to trade throughout the day, but why is Gabelli, really jumped in, for ETFs at this point?
Right. So I think if you look at the history of the Gabelli organization, certainly very innovative, in terms of mutual funds, closed-end funds, some alternatives, et cetera. So, we've always had an entrepreneurial, I've used that word enough, innovative culture here. And, you could see the trends in ETFs. And I think we were attracted to them because of their tax efficiency, which we aspire to anyway with our own platform. And so the market demand from investors for these type of vehicles has been there. And Mario saw the writing on the wall. And so we've launched 5 vehicles. I was one of them, obviously, with this offering. And I think it's been a good resonance with investors and shareholders, because they're looking for this type of vehicle, intraday trading, real-time updates in terms of pricing, and then the tax efficiency we talked about. But from my perspective, what I love about this is the democratization and communication with retail investors. So one of my first shareholders was actually somebody that reached out to me. I went to high school with him, and he works at a job in the Midwest, and he emailed me and said, I'm so excited about this new offering. I don't have a lot of money to spend, but I want to buy some shares. And
Right.
so I don't know how many shares he bought. It could have been 10, it could have been 100, but it enables shareholders to be owners in this business, on a very small level. So I think that's a wonderful component to this ETF business, and the access and then kind of the communication from the portfolio managers.
Right.
So it's a great business. And then I would just say, as you highlighted earlier, we've been in this huge beta wave and some resistance by the industry to get on active. And now this has become a much bigger wave. And so people are embracing the active, and you need companies that have executed, have track records and commitments to the active space. And I think, we're well positioned in terms of that for what we do here.
Yeah, and the number one question I get about ETFs is liquidity, right? And so, what I like to point out is that, ETFs have two layers of liquidity. You have primary fund liquidity, and then you have secondary market fund liquidity, secondary market stock liquidity. And so what I think a lot of investors don't realize is that an ETF is a basket. And when there's a demand for, even on say a $25 million fund, if there's a demand for 100,000 shares, that liquidity is readily available. What you want to do is, if you're have your RIA or your financial advisor contact their fund desk, they get in touch with the lead market maker, and you can create a very efficient buy, penny, 2 penny spreads, and that there's really no, on a large cap fund, I won't say it's infinite, but there's vast liquidity. And so I think that's something that, a lot of investors, aren't aware of, but that the ETF wrapper does provide that.
No, I think that's a great point. And investor education around ETFs, continues to evolve. And I think that people understand. And as you say, the liquidity really comes from the underlying securities. And that's the important part. And if you look at our portfolio, when we own JP Morgan and Berkshire Hathaway and some of these other companies, they're deeply liquid. So we're not moving markets with our portfolio or asset flows. And so investors should be confident that even though they may not see active trading in it, which we don't embrace, we don't want that. We want investors that, when you contact the block desk at Schwab or at Fidelity or at your own firms, that they can facilitate trade. And the reality is they can just mimic the basket, create it similar to, whether they do that for spiders or some other ones. And so it's there. And so I think that's an important message to get across, that if you want to have a piece of this business and our portfolio management outlook, then, it is more accessible than what it may look like. We're proud of that. And I think, as the asset flows and the appreciation for that will continue. And then I would also say that, differentiation is a big deal. And, if you look at the kind of our sector, 100 funds or so, I would say 99% are beta. We're one of 2 funds that are active that do it. And so I think there's an opportunity there. So if investors do, kind of a little more research and, they can see what's going on in terms of performance, I think that's helpful. And then at this point, we're waiving our fees. So I think that's also helpful relative to, some of the larger funds as well.
That is extremely helpful. And so if I wanted to buy GABF, I could just go onto an online account or contact my broker, and they can access it and buy me shares readily available.
Absolutely. Yep.
Well, great. Well, we're going to wrap up now. Thank you so much for your time. I really appreciate it. And hopefully we'll be back here talking about performance in the next 3 to 6 months.
Great. Thanks, Michael. And best wishes to everybody for a pleasant holiday.
Thank you very much.